Welcome, everyone. We're here for another episode of the Endeavour Exchange here with my colleague, Grant White, where we're going to be talking about all the different trends affecting your money today. Been a little bit since we've had an opportunity for Grant and I to sit down and put one of these out. So excited to kind of get back on here and get the conversation going. And the first topic that I wanted to cover here today, Grant, has to do with cars. And we talk, this comes up in personal financial conversations all the time. We talk about cars and the how much of a depreciating asset cars are often. And when we look at it, telling clients like just be careful of how much you spend on that car because of the fact that it's a depreciating asset. But right now, we're actually seeing something a little different, and we're actually seeing some appreciation in cars. So, the question I had to you, Grant, is since when do cars appreciate in value?
Yeah, so we're putting all clients' money into cars.
That's a joke.
Yeah, no, we're not doing that. We're not doing that. It's funny because you mentioned you and I haven't done this in a little while, and partially that was pandemic related and so on and so forth. But like so many things out there right now, the pandemic has had a massive impact on the world, and this is no different. So really this comes down to the semiconductor shortage that everybody's kind of heard about, probably maybe even read about. The semiconductor shortage, the chip shortage worldwide has caused some interesting effects in many markets. I mean, I was reading this morning about Apple and how it's starting to hit iPhones and smartphones in general. Actually, like the shortage is certainly going to have it is playing a role, and it will play a role there as well. Apple is certainly optimistic that they're going to sell actually way more iPhones in the next year than last year even. So they don't think it's going to necessarily hit them, but it has over the last year. But getting back to your questions. Yeah, it's hit the cars. It's hit cars. And so like anybody trying to buy a car right now would know this. Like trying to buy a new car right now is somewhat difficult, and lots are having difficulty getting cars on the lots. So you might be able to go in and buy what they've got, but if you have something more specific in mind, it's very difficult to get that right now. And it's even impact pre-owned vehicles because the just demand is really high. Interest rates are really low, so that's playing a factor into it. So demand's high, and there's a shortage of supply. And so what does that cause? Well, as we know from economics, like when those two things are going together, then you're going to get price appreciation, and so we're getting price appreciation in cars, believe it or not. So
and actually, we have three charts that we can throw up here.
Yeah.
That I believe came from the Wall Street Journal. One showing the average wholesale price of used cars on a monthly basis, and then the other one looking at the share of borrowers with negative equity when they're trading in their cars. And typically, you do see a lot of that negative equity. And then the third chart, but now we're seeing that be not the case. And then the last one is the net charge-offs on auto loans. So when these companies are taking back the cars of defaulted borrowers and now they're actually able to sell them for a profit, and they're not taking a loss on the original bad loan. So
yeah. So we've got the charts. Here's the stats on it. Like used car prices are up 34% year over year. So the same car you would have sold last year or bought last year, if you're buying it today, it's 34% higher in price. And you're right. That's translating into like even on vehicle turn-ins, like when you're trading it in, most of the time those vehicles are underwater. Like that's almost part of the plan. It's underwater. 25% less vehicles are 25% less underwater today than they would have been a year ago. So this is where price appreciation is taking it, and where that actually impacts as well is on the banks and the lending side as well, because there's always a number of defaults out there on vehicle loans, and that's to be expected. Every year it's the same. Pandemic, market economics, doesn't matter. That happens every single year, but the banks are actually making money on some of these cars right now. So they're taking the defaulted car, they're pulling it in, they're selling it, and they're actually pulling in more money than what's outstanding on the loan. So it's kind of crazy from that perspective. So this is having a big impact. It's a big impact on people trying to buy a car. Certainly, if you got a used car you want to sell, now's a great time. They're really hard to get cars right now, and our friends over at many of the the car lots, the dealership owners would know this. Just because it's trouble probably getting inventory in. We were seeing that, and again, I've heard it from many clients. Now the question is, will it last? No.
And likely not. And that's the flip side on the lending side of it, right? For any new loans that are being issued on some of these pre-owned vehicles, there's a risk there to the lender that if at some point down the road they're having to pull that car back and take possession of it, it's actually worth less than it was when the loan was originally put into place. So, I'm sure they're well aware of this and they're looking at it, considering the data that we're getting is coming directly from them. But it likely is not here to stay forever. And as supply chains work themselves out, car prices, along with a lot of other prices, should be coming back down to earth.
Yeah, I suspect you have maybe a few months left in this, to be honest. Like there's a very short window of opportunity here, potentially opportunity or just an enigma, if you will. But it's a very short period of time. Like semiconductor production is going to ramp up again. Like that's going to happen as the pandemic eases, and so we're not out of it yet. But it's this is a short-term thing that's going to get worked out. But such an interesting stat point or data point from, again, such an interesting time given the pandemic. Like, who would have expected, like, when you're drawing the lines, connecting all the dots between the start of the pandemic and now, who is predicting, oh, well, used car prices are naturally going to go up because of this? Like, nobody was connecting those dots 18 months ago. So just kind of an interesting, effect that's going on. And like I said, I mean, it doesn't, even though semiconductor production will pick up, it takes a while to get things back rolling and get inventory going and so on. And so, it's an interesting time we're going to be dealing with for a while. But I would say if you are looking to sell a used car, now is probably the time. I wouldn't wait too much longer because it's not going to last. So, speaking of debts, because debts play into what we like, more personal debts typically when we're talking about like insurance and how much insurance people should have on the financial planning side of things. So how, Brent, that's the question. Like, and we deal with this virtually on a daily basis, but how much life insurance does one need?
It's a bit of a tricky question. I know that in asking it, but we're speaking. Yeah. This is actually a question that came in from a viewer. The reality is it's a tricky question. Every client situation is entirely different. I think it's helpful to first think about what life insurance does in order to evaluate, how much of this do you need? What is it doing for you? So life insurance, at a very basic level, is really a risk management tool. It's meant to provide easy access at funds at the time of an individual's death. And for most families, the need to access these funds are for things like, you talked about debts, Grant, paying off mortgages, other debts, having enough funds to send your children to university if there's young children involved, funds to replace the income of the deceased in order to just maintain the existing lifestyle as well. And in the case of like high net worth individuals, we often see the need for excess cash to fund things like tax liabilities on capital gains and taxes at death. And if there's a business involved, the purchase of a business. So there's lots of different variables that factor into how much life insurance should be on one's life here. So I don't necessarily know we're going to answer the question as to how much life insurance one needs. Yeah. But I can go over some of the basics that we look to cover for a typical family. And so when we're evaluating a family's life insurance situation, we're always looking at what are all the debts out there, the mortgage, or the credit card debt, or is there any line of credits? And we want to make sure that we, I'd say 99.9% of the time, we're covering all of that for families. We're making sure if one of the spouses were to pass, that is all taken care of. We'll often tack on a little bit for burial expenses, so there's money there for funeral or whatever arrangements need to be made. The reason why I think this is such an important topic to talk about today is about the income replacement. Really, your biggest, most important asset from a personal financial perspective is your ability to earn and the future earnings that you're likely to make. And when there's a family, if one spouse passes, this leaves a significant gap in a family's total earnings. And really, it's when we look at the need for life insurance, more often than not, it's the largest component of that need. And so it's also the reason I believe many individuals underestimate how much life insurance they actually need. They think in their heads, I got this debt, that debt will be gone, and this will be paid for, and family's all good. But at the end of the day, it's not just the existing, like in plain sight liabilities that you're trying to cover here. That income replacement is so important. And so what I wanted to show here first, we have a little bit of like an Excel image here looking at a couple, just an example couple here. We have Jessica and David. Jessica's annual net income is about $110,000. David's annual net income is about $68,000 for a total family net income of $179,000 approximately. And so I talked about how when we're doing life insurance, we look to make sure those debts are gone. We look to make sure, if the burial expenses there. When it comes to income replacement, it's always a conversation. We typically like to aim for 80%, replacing 80% of that total family's net income for a certain period of time. So typically this is either 10, 15, 20 years, and that'll all depend on, often someone who's closer to retirement who wouldn't be making an income anyways doesn't need 20 years of income replacement. They've done what they need to do to prepare themselves for retirement. But a younger family where they have 20 years of earnings ahead of them might want to protect those earnings if something were to happen to the couple here. And so I wanted to look at we'll go to we have another graph here just to show you the breakdown of that kind of insurance need. And so David, this is looking at insurance needed if David passes. You'll remember David was the lower earner of the two spouses. He made less than Jessica. So you'll see here in David's case, we're looking at 10 years of income replacement. The mortgage is the primary kind of piece here that's being covered off, $550,000 mortgage. However, the income replacement is still a big part here at $329,000. If we take a look here at the next chart, we're going to look at the same chart, except for Jessica, the insurance need if Jessica passes. And what you'll instantly notice is Jessica, the higher earner here, all of a sudden, the amount of insurance that she needs is bumped up dramatically with that income replacement. There's $749,000 of insurance needed just for the income replacement. Then you tack on the $550 for mortgage, the $35,000 of other debts. So the point I'm trying to illustrate in showing these is how much the income influences the insurance need. Mm-hmm. And so sometimes people they'll hear, oh, you should probably have $2 million worth of insurance. They're like, $2 million, that sounds like a lot of insurance. But again, that income is so important. Now I just wanted to take a look at the same scenario. So, we're looking at Jessica and David here, but maybe looking at a 15-year income replacement, and you're going to see those orange kind of sleeves shoot right up. So here's insurance needed if David passes with 15-year income replacement. You'll notice he's now almost half of that insurance now. Before it was probably 35, 38%. Almost half now is income replacement for David, the lesser earner of the two. And then if we look here at Jessica again, so insurance needed if Jessica passes, 15 years of income replacement. In her case, the high earner of the family, that orange part of that pie chart there becomes the most dominant part of that pie chart. And that's really, when we're looking at it, that's what I wanted to demonstrate with this question is there's no right or wrong answer. I mean, we always like to take care of the debts. Who wants to leave their family with, debts that they have to pay for? But more importantly, the income replacement needs to be looked at. And sometimes people shy away from insurance because they think, it's a lot of insurance, but it just goes to show you here, if we're trying to make sure that the family can maintain a lifestyle, kids can still be involved in their extracurriculars, if they're in private school or you're planning for university, losing that income of that second family member, that's a huge hit to a family's financial plan and ultimately can put the plan in jeopardy. So unfortunately, I can't answer the question of how much certain listeners need, but this gives you an idea of how to start looking about what you might need insurance for in order to evaluate what what you might need. So again, we take care of debts. We often add in some money for the burial expenses. Then really it comes down to that income replacement. It's a conversation between the client of, depending on where they're at, how much income replacement do they want? We try to target 80, and for how many years do they want that replacement? And we always say, we can provide you in it, or we can guide you in this, but at the end of the day, the client has to decide what they're comfortable with and what they're comfortable paying. I like to lean towards being, aggressive in handling that insurance. And if, insurance, if you're healthy, able-bodied, and, in your 30 to 40s, month to month, for the security that it provides, I think it's pennies on the dollar. So when you kind of understand what makes up that need, you're a lot more willing to spend on these types of products. I don't know if there's anything you'd like to add to this, Grant, but
I just think it's like, you're willing to insure, like this is always the thing. Like people are willing to insure their house. Your house is worth, I don't know, let's say it's $500,000. So that's a big asset, right? And often people say, oh, it's my largest single asset, or it's one of my largest single assets, I'm going to insure that. The numbers you show on income, nobody's insuring their income, or very few people are insuring their income. But even if you got $100,000 income, and if you were looking to replace 20 years worth of income replacement, if you're a younger person, that's $2 million. Like that's 4 times your house value. So why would you not insure that? And to your point, you can do it really cost effectively. Like you don't need like a big permanent policy. You're looking at a short-term need, like 10 to 20 years, somewhere in there. So you can use term insurance. You're talking about like pennies on the dollar that you're paying for this coverage, but it's peace of mind. But really, like the question you just need to ask yourself is, if something happens to you, what happens? Think that through. Like if something happens to you, where's your spouse, and where are your kids, and what happens?
And
just run some simple math.
$40, $50, $60 a month, is that worth putting your family in jeopardy? Depending on, your obviously the premiums depend on age, health, but any situations we see when we're looking at term insurance for most clients, like it's such a no-brainer. If we opened up your monthly spending and took a look at your month-to-month cash flow and some of the things that people typically spend on, and truly ask the question of them, like, is this more valuable, or is this more valuable? I think making sure your family's taken care of is probably pretty important to most.
And you don't have to give up your Starbucks every day. Like that's the thing. Like you can keep going to Starbucks, but do this. And again, I think it's just like, remember, this isn't about you. You're gone. This is about your family, So anyway, I'm passionate about it because we often see this type of coverage. People aren't covered for it, and the concern I would have is what happens to your family? And likewise, if you ever want your spouse to be able to retire, like if you ever, there might still be delays in that, even if you're insured. But if you ever want your spouse to be able to retire, if something were to happen to you, having adequate income protection in place it might be the difference between them being able to retire at some point or never being able to retire. So
working till they're 75.
Yeah. So again, it's a passionate topic for me, just because we see it all too often that people. I get it. Nobody likes insurance. You got to die to get the money out. I get it. It's not fun. It's not sexy. It's not like buying stocks. It's not. It's it's not a fun thing to buy. But at the end of the day, there's people you care about. There's things you care about. So take care of it. That's what it comes down to.
Now, Grant, this kind of has some it has some ties into the first topic when we were talking about cars and the prices of cars. There's been lots and lots of talk about inflation since we've started to see this kind of economic recovery and this willingness from consumers to spend and go out. I know we're all obviously we want to be able to do it in a safe environment, but everyone is ready to get out there and enjoy life and do the things that they enjoy more than ever before. Like it truly, I feel it in myself through the people I talk to, friends, family. Like behaviorally here, you have to think like everyone wants to get out, and we're going to be willing to spend on experiences, eating, dining, entertainment, all of these things, because these last years from a social interaction standpoint have been really, really tough. And so because of that, because of this demand coming, and some of these supply chain issues, we've seen the inflation numbers kind of tick upwards, and much of the talk has been that they're transitory and short-term in nature. And we're actually now, there's been some data that's suggesting inflation may be pulling back slightly from what some of the readings we got a month or two prior. So the question I have for you is inflation starting to ease?
It's a good question because, yeah, I mean, anybody who's been buying stuff, you've been buying gasoline, you've been buying houses, you've been buying cars, evidently, even used cars, you've seen inflation, and inflation certainly has been running high for some time now, and well above the band. Central banks like the Bank of Canada or the U.S. Federal Reserve, they want inflation around 2%. That's like their band where they would like to see it. And now we're running above 3%. And so that's high, and under normal circumstances, what typically would happen is we'd see interest rates climbing. They'd increase rates to bring that inflation back in line. They probably would have done it some time ago, but that's not happening. Why? Because the central banks, to your point, thinks this is just a transitory thing. We're coming out of the pandemic, and so this inflation is somewhat artificial, is kind of their standpoint on it, because it's going to correct itself as things normalize coming out of the pandemic, and as things get back to normal. So the question is that going to be the case? Now we've been talking about inflation around here for well over a year, and whether or not that is going to be the case, I always worry if they're wrong. But here's some interesting data points that did come out, and one of the key. This is really interesting to me because one of the key indicators of whether or not inflation is going to be higher in the future. It's not numbers that people look at. It's not like there's not this big statistic that people are drawing numbers of like prices of this and that. No, what it is expectations of people, investors, businesses on what they're going to spend or what prices are going to be like, this year, 5 years from now, 10 years from now. And so they do a survey and they find out, what do you think's going to happen? and because it's a bit of a self-fulfilling prophecy, because if you ask people, what are you going to spend? It's almost like, what are you willing to spend? What are you going to be willing to spend on something? And that ultimately is part of the market that's going to indicate what prices are going to be. So it somewhat is a self-fulfilling prophecy, and that's why it's used as some of the key indicators of what inflation is going to be like. So there's been these surveys going on, and so inflation is running high. We know that. And the expectation for inflation over the next 12 months, based on these surveys, what people think and what businesses think is going to happen, is 5.4% inflation. That's the number that was kind of picked out as expectation. So that's really high, obviously. This is in the US, by the way. So this is 5.4% in the United States. But if you take if you look at the longer term numbers and what the expectations are, so you go to over 5 years and over 10 years in particular, the expectation for inflation is back into the 2% mark. Points.
Kind of
2.9 was the number that they had, but he was like, yeah, it's getting back to normal. Now that's taken into consideration that we're really high right now, so it's coming down. And the point is, this would if this comes to fruition, like if this self-fulfilling prophecy, as I said, comes true, then it would kind of justify the central bank's positions that things will normalize, inflation will normalize. And so if that's going to be the case, then that's actually it's probably a good thing for a lot of people, because interest rates can remain lower for longer, and it would justify central bank's positioning that they're not increasing rates right now, despite the fact that like stock markets are hitting all-time highs, despite the fact that inflation is running high. The argument they're making is that there's still room to grow, and then unemployment is still an issue, obviously, too. So they're looking for unemployment numbers to improve, but that would be the point that they're looking at. And so I guess, long story short, is it easing? I think it's too early to say if is it easing today. No, but is it the expectation that it will ease? Yes, the expectation is that it will ease, and if this is a leading indicator, as I'm saying, then that likely will happen. But you always wonder, what if you're wrong, right? And if you're wrong, then what does that look like? And if the Federal Reserve and the Bank of Canada are wrong, then they're going to be forced to make decisions that they might not want to make, like increasing interest rates faster than expected. And so I still think this is a concern that people need to be aware of. If we're wrong and inflation does normalize like they say it will, then guess what? Well, there's nothing really ventured, nothing lost on our part. Like, it doesn't matter. Like, we'll be fine. They'll be fine. Our clients will be fine. But if they're wrong, and we think they're going to be right, then that's a bigger problem for a lot of people down the road. So it's worth hedging your bets on, I guess, is my point.
Well, yeah, you have to look at the risk of, okay, if they were wrong, what is the risk? How severe? How bad would it be? And in a environment where inflation is high, it's a very difficult environment for investors, for consumers. It's tough, right? So I would rather have some preparation and be prepared for that than be caught off guard, because being caught off guard leaves you in a much more difficult situation there. So.
Yeah, it's not a good spot if inflation continues to run high and then interest rates have to jump by half a point, 1 point, whatever or more in a very short period of time. That's not a fun place to be. It also dovetails into debts, personal debts. We always dealing with the question of like, should you be paying down your personal debts? Well, money's really cheap right now. Why would I do that? Well, money's so cheap and so on and so forth. Well, money might not be that cheap for very long. The Bank of Canada has already raised flags saying that, hey, interest rates aren't going to stay this low forever, which is them basically sending you the warning sign. It's the interest rates are going to go up at some point, and maybe not in the too distant future. And so, for personal debts as well with variable interest rates, now is actually a good time, in my opinion, to start chipping away at that, because it won't necessarily remain lower for longer. Granted, there's the trade-off. Like if your investments can earn 7% and your debt's only costing you 2%, there's obviously that 5% spread there. And so, there's not a lot of incentive financially right now to do that. But in saying that, this 2% might quickly become 3 or 4% or more in the next few years. And so anyway, just something to be considerate of. But yeah, I mean, inflation is certainly something we're watching very closely and we'll continue to watch very closely. But I did find this survey really interesting, and that the fact that that's often used as a leading indicator. We've never really looked at it like that, but I think it's actually pretty interesting that that's something that's often looked at. So Brant, like we've been, especially around our office, but we've been chatting a lot about China more recently, and what's been going on with the political environment there as it relates to Chinese businesses, and a little bit of a crackdown, a little bit more regulation, things like that. The question is, should you be invested in China, as a basic question? And that's a pretty loaded question because there's a lot of things going on there. But what's your take? Should you be invested in China?
Yeah, I was having a conversation with Craig, our portfolio manager here in the office the other day, just on this topic. We obviously own some positions in China, so we've been following it very, very closely. What's been happening, as you mentioned, there's been a pullback in the market with a lot of Chinese companies, and specifically tech-related businesses, just due to some fear over some of the regulatory actions that the Chinese government is taking, and perhaps the continuing to sour relationship that they have with the United States there. With all that in mind, I think it's important that we keep things in perspective here. And recently, here in North America, anyways, the media that we've seen, in my opinion, has largely misrepresented what's going on in China, or is extremely biased. We're hearing people like Jim Cramer come online with his very brash and aggressive opinions of what's going on, and I don't think that helps investors very much, because like I said, I think there's some big misrepresentations. We have to remember here, the U.S. and China are very much butting heads, and they are each other's number one adversary. So if we were getting our news from Chinese outlets, it probably looks a lot different than what we're hearing here. And I wouldn't say that here, obviously there's some skepticism over media and propaganda in China, but I wouldn't say we're free from bias here in North America either. So I think a lot of what's going on is people are feeling that this regulatory crackdown is the Chinese government kind of reasserting the former kind of Chinese communism that we formerly had seen over the past, like prior to the last kind of 20, 30 years. And what I think Westerners need to understand is that, China, their people, their government, they operate very differently than we do here. And
Mm-hmm.
what they're comfortable with and what they're not comfortable with is entirely different. Right now, there's no evidence that China's trying to kill off their own companies. These are businesses that that country needs to continue their growth. And I know they want to overtake, we all know they want to overtake the United States as the largest nation on the planet and become one of the most powerful. They're already one of the most powerful nations, but they have their set sight on being number one in that spot. And they're not going to do things that would ultimately jeopardize that. So I think there's a little bit of noise going on, and actually with some of the things that they're taking aim at, it remains to be seen whether they're right or wrong. Like you look over here at North America and what's gone on with a lot of our technology businesses, some of the prior financial crises that we've had, and from China's point of view, I think they're taking a look over to the West and going, look at all the problems they're having with these businesses, and is there things that we can do to clamp on now to ensure that we're not dealing with the same problems? And you have to know they like control a lot more than that. That's if you're investing in China and you didn't know that, like that's we know that the government wants to run a tight ship over there and have kind of their finger on the pulse on every direction. And through my conversation with Craig, he made the point. He goes, the model to me seems clear. Don't criticize the government, which is what we saw with Jack Ma and Alibaba there. Don't do things against the direct instructions of the regulators. Don't run a business contrary to the government's stated goals in their 5-year plan. Education, gaming, their financial industry, these are all a part of their 5-year plan. And so if you're in that sector, you're likely going to have to follow their rules, because that's on their radar. They are actively trying to create growth from these various areas, and don't make a spectacle of yourself. Again, like what we saw in Jack Ma. And in the case of the Ant IPO, I talked a little bit about this already, but they made it clear that they're concerned about the stability of their financial system, and whether or not we agree that Ant Financial was a threat to that doesn't matter. The regulators believe that it could potentially be, and just like North American banks, Chinese banks have to work within their regulatory framework. So when we look at Alibaba as Ant Financial is it's a big portion of business for them, but when we look at their entire business, it's not ultimately that big, and the company itself came out relatively unscathed. And as I mentioned, these are companies that align with China's strategic priorities. They're increasing personal consumption through their e-commerce. They're in AI, cloud infrastructure, optimization of manufacturing facilities. So again, I don't think the Chinese government is coming in to throw the hammer down on these companies. They're just coming in to make sure that the machine is working the way they want it to work.
I would agree. I think that if they wanted to make a statement, they had more than enough opportunity with Alibaba, because they clearly had them under review, and there was a fine assessed to Alibaba. But to your point, it was a wrist slap. If they really were looking to do something there, they would have done it, in my opinion. But I think you made a really good point. I mean, like, clearly China is looking at what's happened in the United States, where you've got the FANG stocks, the FANG companies, who make up such a huge portion of the S&P 500 that, I mean, it's hard to argue that there's not monopolistic characteristics going on there, because the companies are so big. I mean, look at Facebook. I mean, they're dominant in social, like dominant. And yes, there are some other players, but let's be honest, it's not that close. It's not that close. You've got Google, dominant. These are businesses we love, by the way, but they're dominant in search, like not even close.
And the power that they yield on the consumer, and the ability to spread messaging. We've seen meddling in elections. Like, there's a lot of good that has come from these businesses, but there's also a lot of kind of negative components and some challenges. And I don't necessarily know. I don't know if they're right or they're wrong. I just don't necessarily know if everything that they're doing is wrong. And
Like time will tell on that, right? Like so I mean they're looking at where North American companies are, in particular U.S. companies, and obviously there's challenges. Like look at all the companies that have been dragged into ahead of, in front of Congress to in the Senate to talk about monopolistic and antitrust type of issues, and anyway, long story short is China's looking at that and basically saying, well, if Alibaba like becomes this, maybe we have a real problem down the road, like a big problem. And so it's no different than somewhat happened with Microsoft, some time ago. And anyway, you're right. I mean, the point is, we don't know that they're wrong in doing this because it actually might create a far stronger economic system down the road. And likewise, I think they have some concerns, obviously, over the stability of like their financial system as it relates to even like cryptocurrencies, which they've also cracked down on. But again, are they wrong to do that? I mean, time will tell.
Time will tell. At the end of the day, like we've been investors of Alibaba and Tencent. These two businesses are extremely strong businesses. Mm-hmm. The short term, you're going to see some short term pricing troubles as the noise kind of amplifies. But keep this in mind: Alibaba is more profitable than Amazon and is growing at a faster pace, and only trades at a quarter of the price with a much larger market here. So, if you're one of these individuals that has a hard line on investments in China, I understand. I can get behind why you wouldn't necessarily put money to work in China. But for those, who may be already owners of these Chinese equities, in our mind, this is not the time to be selling those equities because you're hearing some noise over this. Like, these businesses have a long runway. They have a large and fast-growing customer base. They're more profitable than the super businesses here in North America, and they're trading at significantly lower valuations. So, if anything,
I think it's worthwhile looking at the growth chart of companies like Amazon, Netflix, Apple, any of those companies as well. It wasn't a straight up line, by the way. No. Like, people tend to forget that, but it was far from a straight up line. And all those companies have faced regulatory issues in the United States as well. So let's be honest. If you're looking for big growth opportunities, don't expect it's going to be a straight line upwards. But for all those reasons, I would honestly be really surprised if certainly 10 years from now, if like an allocation of something like 10% or something around that line isn't almost like normal course for a Canadian portfolio, like 10% to China. I mean, again, it's the second biggest economy in the world. In the next 10 years, it might become the biggest economy in the world with some of the biggest businesses in the world. So it's pretty hard to ignore the opportunity there if you're really interested in growth.
Absolutely. Well, with that, it concludes our questions for the day here, Grant. Nice to be back on again. Another Endeavour exchange. Always fun doing it back and forth here. As always, if you have any interesting questions, any topics that you'd like Grant and I to talk about, you can always reach out and let us know. Check us out at www.endeavourwealth.ca. You'll find our profiles, our contact information there. You can check us out on YouTube, LinkedIn, Instagram, Facebook. We're on all the kind of major platforms, and we love talking to people that are interested in personal finance and investing. And if there's anything, like I said, if there's any questions, any challenges you're facing, we want to hear them, and we'd be happy to address them here on one of our episodes. So with that, we can sign off. Thanks again, Grant.
Thanks very much. Take care, everyone.